Hello there, good evening. Welcome to the Jim Bohannon Show from Westwood One Radio. We're at 1-866-50-JIMBO, 1-866-505-4626. Online, you'll find us at jimbotalk.net. You can follow me on Twitter at JimboTalks. As we're going to be looking back this evening to the anniversary of the Lehman Brothers bankruptcy that, of course, began the financial disaster of 2008. And many people remember that period, of course, very well, 8 years, and how much recovery have we really had in that. It was on September 15th of 2008 that the banking giant filed for Chapter 11 bankruptcy. The Dow dropped over 500 points, 4.4% in one day. The U.S. economy was well on its way to recession. And indeed, the very future of capitalism was being questioned by some. Well, that proved to be a little bit Armageddonish, but nonetheless, we are going to be talking about this tonight with the executive director of Main Street Growth Project, online at mainstgrowth.com, Kyle Hauptman. Good evening.
Jim, good to be on, man.
Yes, indeed. Thank you for joining us tonight. First of all, what have we learned in the intervening 8 years?
Not nearly enough. That's my view. By the way, you mentioned the future of capitalism question.
Yeah.
I think the future of capitalism is still being questioned, don't you think?
Well, it may be questioned. I don't know that it's being realistically questioned. It's obviously not going anywhere for the moment. I mean, who knows, down the road, but I would certainly think that for the bulk of this century, as far as we can foresee, it doesn't seem to be in any great danger, barring a truly cataclysmic economic downturn that would make 1929 look minor.
Yeah, free enterprise, capitalism has been the best thing that's ever happened to the poor. You know, you and I both have relatives that at some point, I'm sure, were very poor folks. And the only thing that ever got them out of there was free enterprise. But back to your original question, Jim, what have we learned? It is amazing. We're sitting here, so we're 8 years later. And I remember that weekend very vividly. I remember September 15th, 08 very vividly. If you told me right now, if you told me back then that we could fast forward 8 years, I would have said, you know what? If I had to predict 2016, I guarantee you at least, at minimum, they've scaled back or eliminated Fannie Mae, Freddie Mac, FHA, these bizarre U.S. government programs for housing. That's the first thing I would have said, and I would have been wrong, because they are going strong and promoting mortgages that the market by itself would not allow.
Really, so not that much. Now, I recall, not personally, but from reading about it, the lessons out of 1929, among other things. The Securities and Exchange Commission was created, and we wound up putting a limit on the extent to which people could buy stock on margin or on credit. In other words, there were institutional reforms which presumably worked. How many institutional reforms have we seen in the past 8 years?
We've seen a lot of reforms, I think. I think a lot of them are not good, though. Some of them were. So if you've seen the movie The Big Short, or if you have read the book, I'm not a fan of the tone they took on a lot of things, but one thing it did very well was talk about how weird the mortgage process was back then, 2006, 2007. So there has been some strides on those ridiculous mortgages, you know, the no docs, no job, no income, you know, none of that stuff, right? That's gone away. So that's a good thing. I think we're all happy about that. But the big winners have been Washington, D.C. as a metro area. I live in D.C. It produces very little, but it's thriving. Lobbyists have had a terrific time. Even the New York Times called the Dodd-Frank Act, which was Obama's response to the crisis, they called it a bonanza for lawyers and lobbyists, massive bills. The lawyers win as usual, and political appointees. We've had a recovery, which we always do from recessions, but I think that we have favored everything that's big. Big banks, big cities, big companies, and there's a lot of data to prove that. And one of the things I do every day at Main Street Growth Project is try to talk about how do we bring back Main Street America, the entrepreneur, the American dream, the immigrant entrepreneur opens a business, that sort of thing.
I seem to recall 4 words that I heard a lot back then. Haven't heard them lately.
Too big
to fail. Yes, sir.
Yeah,
whatever happened to that?
Well, it's interesting. I mean, so there are they have a lot more capital. So I would say the big banks are, but remember I said, you know, I would be amazed if you'd have told me back then that they would have done very little to rein in these government-backed mortgages where you get 3% down, right, which are basically underwater when you get the keys. The other thing I'd be amazed about was that the banking system would be more concentrated, not less concentrated. We'd be better off having more competition in the financial space. so that there wasn't any one entity that was that, massive that could bring down the economy. It has not happened. Credit cards, mortgages become more concentrated. It's because of Dodd-Frank and other bad regulation. Dodd and Frank, the two politicians plus President Obama, put through a very big government liberal way of handling the financial crisis. And I think they made themselves, D.C. and politicians and appointees, very powerful. But in my opinion is this is the article I wrote today. You can find it on medium.com. Put it up last night about when I was at Lehman Brothers back in the day. I was a mid-level money market trader. The only way to end too big to fail is so they can fail just like other industries do every day, go through bankruptcy. United Airlines, U.S. Air did it twice, American Airlines, Kodak. So I think we still have an issue there. Dodd-Frank put together a politically influenced way to shut down a company. You can shoot Old Yeller, right, when it's failing.
Yeah. But
I think that the right angle, and there's legislation in Congress for this, Senator Pat Toomey of Pennsylvania has some bills, other people do too, to amend the bankruptcy code so they can actually go through normal bankruptcy. So the important meetings aren't.
Now, why can't they go through ordinary normal bankruptcy?
First of all, I don't pretend to be a bankruptcy expert. Yeah. The bankruptcy code, for a bunch of reasons, is not well suited to global banks that have massive trades with foreign counterparties and have lots of units, right?
Well, now you say they're not well suited to it. I mean, is there some inherent quality of big international banks that makes it impossible for them to file bankruptcy in one country, presumably the country in which they're incorporated?
Well, so they can definitely file bankruptcy, as Lehman did, and essentially be liquidated.
Yeah.
And they file bankruptcy and it's over. What I'm talking about is what, again, American Airlines has done, Caesars Entertainment, the casino company's done, a lot of big companies done, which is restructuring. You go in, usually your shareholders lose all their equity, that's usually the case. The creditors have to get in line, and you restructure and you walk out of it and you come out a viable company with less debt. The people who bet and lost, because that's capitalism. That's how it's supposed to work. And we would like to see big international banks be able to do that, and it was not possible. And that whole game of chicken you saw in 2008 between Lehman Brothers and the Bush administration, and Lehman lost badly, well, everybody lost that one, was because everybody knew that international banks aren't really well suited for restructuring bankruptcy, where you go into it, you shed some debt, you come out of it later, and you're viable. GM did it. Lots of folks have done this, right? Yeah. And that, I think, is very important. The only way to end too big to fail is for them to be able to fail without political intervention.
All right. Now, if something is really too big to fail, I argued at the time, and I talked with a lot of knowledgeable people, and I never heard anybody just flat out tell me I was crazy. I argued at the time that if these institutions really were too big to fail, that is to say, if they fail and they go under, and it drags the rest of the economy down, then where are the people in the antitrust division of the Justice Department? Something that big shouldn't be allowed. If that is literally true, that they were too big, that we could not afford to let them fail.
Absolutely right. That should never exist. And when they have the ability to go through bankruptcy and restructure, and all the shareholders know they're going to lose their shirt, they're going to bet and they're going to lose. That's how capitalism works, right? And even the people that loan them money are going to lose something. Then they put lots of pressure all the time on them to rein in their risk levels, right? If you remember, there's two things about Lehman that people, I think, have forgotten over time because it was so dramatic, right, when Lehman went down. Number one is May of that year, Bear Stearns. Remember, Bear Stearns was the fifth biggest U.S. investment bank. Lehman was the fourth. Okay, so the fifth biggest went down first in May. And over a weekend, there was kind of a shotgun wedding. And you remember this, obviously J.P. Morgan Chase, with government help, bought Bear Stearns. So Bear Stearns employees went home on Friday night, part of a failing bank. Shareholders went home with terrible stock, with a very cheap stock. The bondholders went home with terrible Bear Stearns credit, and all of them woke up on Monday morning. The employees woke up, J.P. Morgan Chase employees. They might have gotten laid off later, but they woke up. And all the people who loaned them money all of a sudden had really solid J.P. Morgan Chase credit. And it was all done with, government sort of induced shotgun wedding. They guaranteed some losses. Anyway, I think you agree with me. That isn't really capitalism, is it?
Well, no, of course it's not. Although let's face it, raw, unadorned Texas wrestling-style capitalism went out over a century ago. We've had increasingly regulated capitalism. Some would argue that that has made it impossible for another Great Depression. You tell me, is in fact regulated capitalism not an improvement over Wild West-style capitalism?
Well, Wild West-style capitalism, I mean, we can debate the meaning. Regulation is important, but when you have goalpost shifting regulation, I think you agree that that wasn't really capitalism, what happened with Bear Stearns. And more importantly, even though Lehman Management deserves all the blame you can heap on them, and they lost all kinds of money themselves, and I don't, shed a tear for them. It's also true that the goalpost shifting, because everybody knew Lehman couldn't file for bankruptcy the way normal companies do, they thought that their worst-case scenario was one of those shotgun weddings, right? They would get the rumors at the time, by the way, in September '08, were Barclays or Bank of America. And if you're Lehman's CEO, remember when I said there's two things people forget? One was what happened with Bear Stearns. The second one was right before Lehman fell apart, they had a white knight that came in. The Korean Development Bank, big investor from Korea, came in, was going to buy a lot of equity. Everything would have been okay for the time being. Trades would have settled. They were going to buy a ton of equity, inject a lot of capital, but they couldn't agree on a price. And there's plenty of media now, in hindsight, making fun of Lehman Management for that. But in my view, here's what's important. The reason they turned that deal is because they thought their worst-case scenario was being merged with another firm, that there'd be a quasi-bailout, right? It turns out that was wrong. So, Jim, this is the example I give to people when we're sitting having beers some night. I have a watch on my wrist that my brother gave me. I treasure it. It's a gift. It's very nice. And if someone walked up to me and said, "Sell that watch for $5, or I'm going to slap you in the face," you know what? I would take the slap in the face. It's not worth it to me to sell this watch for $5. Yeah. But what if I was wrong? What if it turns out that if I didn't sell it, I was going to get a gunshot to the head? That is what happened with Lehman. They said, you know what, we're not going to take this investment from the Korean bank. We don't like the terms. We're going to walk away. Now, remember, in 10 days, Lehman shares were worthless, and it set off a global, chaos.
Yes.
But here's they thought that their worst-case scenario was a slap in the face. What they did have was a gun aimed at their head. They just didn't know it. And part of this was because the government let them fail, and they thought they weren't going to. This is shifting policy. Listen, Lehman Management deserves all the blame it can possibly get for this, but it is also shifting goalposts. I think it's dangerous. Do you agree with that?
Well, I think I have questions about it, which we will pursue in just a moment at 1-866-50-JIMBO, 1-866-505-4626. Kyle Hauptman is Executive Director of Main Street Growth Project, their website, mainstgrowth.com, and we'll continue our little trip down painful memory lane in just a moment. Glad you're with us on the Jim Bohannon Show tonight. 1-866-50-JIMBO, 1-866-505-4626. As we look back at the 8th anniversary of Lehman Brothers filing for Chapter 11. Not a pleasant time for Wall Street and Main Street, as it turned out. More about which in a moment. By the way, Elizabeth Warren, the senator from Massachusetts, says that FBI Director James Comey should follow the example he set in the FBI investigation of Hillary Clinton's use of an email server. He commented on the case recently and revealed details about it to Congress. And in any event, Warren wrote a letter saying that she wants to know why the FBI didn't act on the recommendations from the Financial Crisis Inquiry Commission to prosecute top Wall Street executives and firms. The commission charged with investigating the causes of the '08 financial meltdown. And that recommended, by the way, prosecuting Robert Rubin, top Treasury Secretary, former Treasury Secretary in the Clinton administration, who was a top executive at Citigroup, as well as the former CEOs and chief financial officers of Citi, Insurer AIG, Merrill Lynch, and Fannie Mae. All right. What about the process of going to jail, Kyle Hauptman? Has anybody gone to jail at all?
Yeah, I mean, there's straight-up fraud cases, where folks have. I don't have too much of a view on the criminal charges. It's not my area of expertise when it comes to financial crisis.
Right.
I would find it a little odd that so much of government was part of the cause of it. If you were going to jail folks, you know, Fannie Mae executives took home $1 million bonuses every year, peddling absolutely terrible mortgages and getting people into homes they shouldn't have been in and mortgages they should not have been in. To this day, Jim, we have government programs backed by you and me, essentially, for 3% down, 3.5% down. And if you know, I'm sure you've bought and sold real estate before. The closing costs are on it. 3.5% down, you're underwater the day you walk in the door because it's impossible to buy and sell a home for less than 3% closing costs, right?
All right.
That isn't some crazy lender. That is your and my government's official policy.
Is this based on the notion that we should all just grit our teeth and take the hit because it's better if more people own homes?
That's exactly what it writes. First of all,
we already proved that didn't work too well, now, didn't we? That people like Barney Frank were complete idiots. Not that we needed further evidence, but that was further evidence.
My comment today, so you asked me what progress has been done. There's been some, but I think overall it's helped that which is big. Big cities, big companies, and Main Street's been left behind. And I think that's where some of the anger comes from, the Bernie Sanders, Trump crowd. But to your point, Dodd-Frank was written by Barney Frank in 2010. In 2008, in July, he was insistent and in his sort of condescending way saying, oh, what are you talking about? Fannie Mae and Freddie Mac are fundamentally sound. Those are his words. You can go on YouTube and see it. This is the guy who wrote the Dodd-Frank Act. Now, would you want to get on a cruise ship and they said the navigation instructions have been put together by the same Titanic captain that said, full speed ahead, no icebergs in sight. Okay? That's what we're living under right now. And you mentioned Elizabeth Warren. What's fascinating to me is she, in her book, when she was at Harvard, 2004, it's a very good book, in my opinion, The Two-Income Trap. Her and her daughter wrote it. She talked about the obsession with homeownership and the government support for it, the mortgage interest deduction, Fannie Mae, Freddie Mac, all this, that all it does is feed that industry out of our pocket. You know, it basically... if I give you a $5 off coupon for dinner and I raise the price $5, I haven't helped you at all, right?
No, you've not.
You know who I have helped? The guy who's selling the dinner, because he gets what you would have paid before plus the $5, right? Yeah. That is what. So Elizabeth Warren, I thought it was very sensible stuff when she wrote her book, and it's kind of reversed on that. We still have a policy that I don't even think increases homeownership rates.
Well, you know, I'm all in favor of the notion that, in fact, we would probably be better off if home ownership rates increased, provided the increase came about because people playing by the same old common sense rules showed more deferred gratification. They saved up their money. They developed a good credit rating and all the personal discipline items that used to be the standard for such things, not if you hand it to them on a silver platter and then essentially you've handed them an anvil which sinks them in the water. I mean,
and how about this? The anvil is financed by the taxpayer. Would you believe that by the time the crisis came around, over half of the subprime mortgages were on the government's books?
No, that would not surprise me. We're coming up on a break that doesn't move, and I want to continue our discussion here. Kyle Hauptman, Executive Director of Main Street Growth Project, their website, mainstgrowth.com. 8 years since Lehman Brothers said, Chap 11, 1-866-50-JIMBO, 1-866-505-4626. We'll be back in a moment. Glad to have you with us on the Jim Bohannon Show at 1-866-50-JIMBO, 1-866-505-4626. We're looking at the 8-year anniversary on September the 15th of 2008 of the collapse of banking giant Lehman Brothers when they filed for Chapter 11 bankruptcy. And we're talking about whatever lessons may have been learned since that time with Kyle Hauptman, the Executive Director of Main Street Growth Project. Again, their website, mainstgrowth.com. I mentioned a moment ago in passing just the catchphrases of the day, Main Street and Wall Street. As we have all learned, their interests do not always parallel one another's. Tell us more about that, how that fit into this, and why the divide between what's good for Wall Street and what's good for Main Street.
Yeah, I think there's always been some difference, and there's always been some similarity. The unfortunate thing I think we've seen in this recovery, particularly since the passage of the Dodd-Frank Act, again, that was the response by Obama to the financial crisis, is that Main Street has not recovered as fast as big companies. The recovery, what they did with Dodd-Frank, is they favored big banks and big loans. If you want a $20 million loan, you're a big company, you probably call a banker. They probably actually answer your call. You speak to a live human, or you want to issue bonds. If you want to have Bohannon's Bar and Grill for $40,000, you want a loan in a small town on a main street in America, that is where we haven't seen the recovery. The regulation has been brutal for the small entrepreneur. The startup economy, like Silicon Valley, is doing okay, but most startup companies, as you know, are not, Silicon Valley. They are dry cleaners. They are small businesses. And that has been hammered by Dodd-Frank and the regulation. So that has been a divergence. Between that and the Federal Reserve keeping rates so low, can you imagine being president, by the way, Jim, and having 0% interest rates for your first 7 years? Be incredible.
Yeah, really.
It's amazing. So it's bad. If you have assets and you have a home, you probably did all right. The Fed helped bail you out. If you're a big company, you're all right. But Main Street, in a lot of places, has been left behind. And we can talk about this later if you want, but this recovery is weird a couple ways. It's weird because it's tepid, and it's weird because of the geography.
Well, now, I know that it's weird because it's tepid, probably the slowest recovery on record. But what do you mean about the geography part? Is it very regionalized?
You bet. It's big versus small. So remember, a lot of regulations in banking, it's a fixed cost business, right? So something that costs, say, $20,000 is not a big deal for Citigroup, but it is a big deal for a small town banking trust that has 3 ATM machines, right? So we don't really care here about the banks. What we're talking about is, Bohannon Bar and Grill or Bohannon, barbershop. That's who's losing here. So big companies and the big banks that lend them money, they're doing okay. They're fine. They can handle the regulation. As a matter of fact, they kind of like it. And I live here in D.C. I hear it all the time. They kind of like regulation because it keeps out their competitors.
Really? This is an artificially induced monopoly or at least oligarchy?
You see it all the time. So, imagine you're an executive at a big company. It doesn't even have to be a bank. You're making lots of money. Life is good. Your biggest fear is not your direct competitor or the market. Your biggest fear is that you're the CEO of Blockbuster Video and life is terrific. And then along comes a thing called Netflix and streaming, and it destroys your whole business. That's what keeps them awake at night, is that something comes along and destroys the whole thing. So when you talk about too big to fail, the best thing that can happen is we have more free enterprise. We have more competition. Competition is the solution to most of these problems. It creates better services. It creates more jobs. So anyway, back to the beginning, Main Street, Wall Street. Main Street has lost into regulation because it's too expensive for them. Austin, Texas, Silicon Valley, around New York City, around Washington, D.C., about 20 counties have more than half of all the new businesses in recovery. That is historically bizarre. If you went back to the early 90s, it'd be over 150 counties you'd have to get to before you got to more than half of the new businesses. Sorry if that's a lot of numbers all at once.
Well, no, but it simply says that the recovery is extremely concentrated. And describe, if you could, describe, please, those 20 counties in general.
Sure. So the tech world, so Silicon Valley, Santa Clara County, that area, San Francisco County, I believe,
California,
around D.C., which produces very little, but we somehow keep having new restaurants every week.
Oh yeah.
And then around Washington D.C., around Boston. So I think that's part of the political disconnect we're seeing this year. The people who life is good, the low interest rates bailed out their stock portfolio, bailed out their housing values. The employers around them, they're part of the big world, big cities, big banks, big companies. They're doing fine. And they're looking out there and looking at some of the supporters of some of the candidates we've seen and saying, what is these people's problem? Life's great. What's going on with all these people? What's their problem?
This happened as an inadvertent side effect, or B, a deliberate plan?
I think it's an inadvertent side effect. I don't know if I'm that cynical. What do you think?
Well, I don't know. I mean, I cannot, I find it hard to believe that it is to the political advantage of anyone to so concentrate recovery. I mean, nothing makes an incumbent happier than a happy electorate.
That's right. You listen to the people around you, and for some people on the progressive side, they kind of like a little bit of control. They want every industry to have, 3, 4, 5 companies, and all the CEOs. Remember, this country is not supposed to have a national capital, Washington, D.C. We're specifically not supposed to be like London or Paris or Rome, where the national capital is also the main business capital. The CEOs are not supposed to pal around with the politicians and their kids go to the same schools. That's how it is in Paris. That's how it is in London. And 36 of the 50 U.S. states, the capital is not the largest city. The CEOs have not moved to D.C. You know who has, though, Jim? They're lobbyists.
Oh, absolutely. The K Street, absolutely. Gucci Gulch, absolutely.
The Great Recession was not a big deal in Washington, D.C. You know how angry that makes people, knowing that, and Washington isn't prospering because we're producing wonderful goods and services and people are using Washington, D.C. apps on their phone. It's just the growth and complexity of government, and the people coming down from New York, from the Wall Street banks, make the relationships happen, and your little bank that has 4 ATM machines that loans to the barbershop, they don't have that kind of pull directly. And these regulations are hitting them harder, and that's why I'm on this show tonight, is to talk about that.
All right, we're going to come back and we will talk some more about same with just a chance for you to call in at 1-866-50-JIMBO, 1-866-505-4626. Kyle Hauptman, our guest, Executive Director of Main Street Growth Project. Back in a moment. Welcome back to the Jim Bohannon Show. Yeah, this is kind of a strange recovery, and for many people out there, of course, the big question is what recovery? With a word just out today, government stats, middle-class income has dropped in the last 8 years, although, of course, we've had some inflation. 1 million more people on food stamps, 8 million more are in poverty, and these are not good things. Looking back at the time of 8 years ago. You make note in the article that you wrote, Kyle Hauptman, and for Business Insider, that the term tsunami was a fairly common phrase during that hectic time. Does that really describe what took place?
Yeah, I mean, it was chaotic in a lot of ways. I remember when the conversation switches from, hey, what are you invested in? You got stocks, you got bonds. When it changes from what are you invested in to who are you invested with, that's a very dangerous situation. And if I could add one more data point, it would be when Treasury bills go negative in yield. So what I mean by that is when they go negative yield, what you're saying is, say for 1 year, you're so scared of all your other investments. You're so scared of who you're investing with that you'll give the U.S. Treasury $100 and you'll take 99 in a year. That's a negative yield, right? You lost money, right?
Yeah, I can do better than that by burying it in my backyard.
Yeah, you're so terrified that you'll take negative yield. So you see that around the world. That's a very scary situation. That is an incredible loss of confidence. And remember, the free enterprise system is the most wonderful thing that's ever happened in the history of the world. It's helped the poor. It's the reason you and I are on this interview right now.
That's right.
Right now, it's astonishing. Listen, nobody in Miami ever gets in a raft to get to Cuba, right?
That's very true. Now, let me ask you something about this, though, because I do not understand this. Yes, it is a time of a lack of confidence. Historically, I had always been taught that in times of uncertainty, that people would run to precious metals. Why has gold not passed $3,000 an ounce?
Well, gold did have a heck of a run there.
Yeah, it did, but why not still?
Well, I think, I've always thought precious metals were a little strange because they don't pay dividends ever.
True. I mean, you have to be really convinced that the financial system's going to hell before you will go to precious metals.
There's two people who are on gold. You see on cable channels, they're always trying to sell you the gold coins. Two kinds of people buy precious metals. One, you actually are very wealthy, and your priority isn't trying to grow your wealth. Your priority is trying to keep your wealth. Concerns about growth are not that important to you. The other kind of people are you're just very worried about everything, and the second degree, Jim, is the people who they don't just invest in the gold, online. They actually take physical delivery and probably have some shotguns and shotgun shells in their backyard.
Yeah, that's probably true. But again, if you are really of that apocalyptic point of view, then that's, I suppose, the sound move to make in that regard. Now, you tell me how close we are to something worse than '08, maybe even worse than 1929, because occasionally you'll hear people talk about that, and some of them sound like there are people who might be at least a little bit in the know. Is that a concern of yours at all?
I don't know about worse than that. What I would say is this. We need pro-growth financial regulatory reform right now. We need to revise the Dodd-Frank Act. We need a real bankruptcy act so we have actual market discipline. We need to boost small business lending. We need to boost the American dream. We need to get the recovery out of just a few counties. We need financial regulation that actually works for Main Street and doesn't just make people in D.C. richer. That would be a phenomenal thing for this country in a lot of ways.
All right, then, which raises a very important point. Since that would seem self-evident, what's standing in the way? Is it those people who are getting richer inside the Beltway, or at least whose representatives are inside the Beltway?
Well, it's very hard once someone gets power to have them give it up. There is a belief that more government control will be better. And it is definitely true that after the financial crisis, there were massive flaws that had to be corrected in the financial system. But it was done in a more regulator, more regulation way, more costly regulation that had victims that are never mentioned in the Dodd-Frank Act, which is what we were just talking about. All those counties who are not feeling this recovery, who don't know what this recovery is everybody's talking about. One thing I want to mention to you, though, is so Barack Obama, when he was inaugurated Jan 09, just as an example,
right,
interest rates were at zero. The Fed lowered to zero December 08. I tell you right now, if I was president and I took office and they had just dramatically lowered rates and were at zero, and 6-7 years later they were still at zero, that would be a major red flag to me. Something went wrong either in the world or with my administration. So,
well, if you know anything about economics, but yes, that's another story.
Very strange.
It is strange.
We're talking about the Fed hiking a little bit this fall or December.
Yeah.
It's incredibly easy money. Here's my point. We may go into the next recession, and this country is due, just calendar-wise, we're due for a recession sometime in the next president's term. Because of where the Fed is right now and quantitative easing and how low rates are, we're walking into this next recession. We don't have a lot of bullets in the clip.
Exactly. In other words, that's the first thing the Fed does. Look, we're heading into recession, lower interest rates. From what?
Jim, I lived 5 years in Tokyo. When I first got there in 2006, I was like, man, this country's a basket case. They're at zero interest rates, and they keep trying to ease and print money. Man, they need help. And a few years later, my home country, United States of America, was in a very similar situation. If we enter a recession with rates where they are a little higher, we're walking into a fight with an unloaded gun, basically.
All right, stay with us. We got more to come. 1-866-50-JIMBO. Back in a moment. We've had 8 years since Lehman Brothers declared Chapter 11 bankruptcy, and that, of course, was a major factor in the big '08 crash. We're talking with Kyle Hauptman, Executive Director of Main Street Growth Project, online at mainstgrowth.com, and talking with John, who calls in from Dallas. Hello, John.
Hello, sir. How are you this evening?
We're well, thank you.
Yes, question for the guest, and I'll definitely check out your website when I get home. The main question I would have is, with some of the criticisms that you're making about where we're at in the country, the economy, how things are getting done, I thoroughly agree. What other country in the world is kind of based like the U.S. economy, going the same direction, but doing it better than us?
Well, there's no two ways about it. Most of the developed countries would trade places with the U.S. right now. We have astonishing strengths. This country has problems. We have astonishing strengths. There are those who would argue Canada. They may have their own little bit of housing bubble as well right now. They have lower corporate income tax. Listen, I do financial regulation, but there's no two ways about it. We have much higher corporate taxes than most places. Every corporate merger around the world, if it's a U.S. company, the headquarters is always outside the U.S. That's a red flag. Burger King, for example, is now a Canadian company. They never do it in the U.S., so that's a red flag. To answer your question, on some policies, I would say Singapore on healthcare, they have a thriving market, and then they have a real market in healthcare, like a normal market, and then they have an insurance back end if you do have a massive thing. But again, on a financial regulation, the U.S. is such a it's kind of like a beautiful high maintenance woman, if you're a man. It has phenomenal strength and some weaknesses. We are in recovery. Things are better than they used to be. But we always go into recovery after recession, and we should have a thriving recovery after a brutal recession. The people who are talking about what a great job all the regulation and taxes have done to this country, you ever have one of those backyard Nerf hoops you could dunk on, right?
Sure.
Well, I had one. It's like 7 feet tall and you're dunking on it. You know what? Right. That doesn't make me Michael Jordan. The people who are talking and saying that massive regulation and interference in our private business lives and all these extra taxes and regulation on the little guy and saying, wow, look, we're in recovery. You're dunking on the Nerf hoop and calling yourself Michael Jordan. Yeah. You just have low standards. It's not a way.
Absolutely. All right. Yeah. Thanks for your call, John. I note here that Republicans want to cut taxes on hedge fund billionaires. Donald Trump, though, their own party's nominee, promises to raise their taxes, saying, quote, the hedge fund guys are getting away with murder. They're making a tremendous amount of money. Wealthy are willing to pay more. We've had a very good run. Your thoughts about that as a policy?
Yeah, what he's talking about is what's called the carried interest tax. And I kind of agree with Donald Trump on that one. Remember, he's also combining it with lowering the business tax, right? So some of that comes out in the wash. This is a complicated subject, but when somebody manages $100 million worth of money and they take a fee from it, or the value of that goes up, right? And they take an amount of the amount that it went up. They take a piece of the profits as part of their income. They call that capital gains when it wasn't their money to start with. So that's the carried interest deduction. Sorry, I'm explaining it in a bizarre manner, but I kind of agree with him on that. But the most important thing is business taxes, lowering those. And I don't even think taxes are our biggest issue. They're a major issue for businesses. Regulation is what is holding back the American dream for a lot of people.
All right. Just a few minutes left to go here. What are other major changes that you think we should make? In other words, what are the lessons that we should have learned?
I think that first of all, even if you're going to hit the biggest banks with lots of regulation, let's set aside for now why they got into trouble back in the day. You've got to make sure that regulation is tailored to the size of the institution. A local bank that makes loans to, Jim Bohannon's Bar and Grill should not have the same regulation as Citigroup does. And we should care about that, not because we care about the little bank, but we care about their small business customers, those who would have jobs there. Most jobs come from new businesses. That's what we need more of. How do we create business starts? And the answer to that is regulatory reform. That's the first thing I would say. How do you get new small businesses and those small loans that they need to get going? The second thing is the bizarre situation with America and housing. The government-backed thing where we just raise the prices of things and push people into mortgages that they shouldn't really have, that they wouldn't be able to get in the open market, and make the taxpayer pay for it, everybody loses there. We have to wind down Fannie Mae and Freddie Mac. They are bizarre institutions. I think the founders of this country would have no idea what they were looking at if you tried to explain to them.
Well, Fannie Mae would, absolutely not. We are at the point where we will pause briefly. Stay on the line. We'll speak off air, Kyle, and the initial public offering for Bohannon's Bar and Grill. We'll talk about that later tonight. Suffice it to say that Kyle Hauptman is Executive Director of Main Street Growth Project. The website, mainstgrowth.com. We're looking back 8 years to Lehman filing bankruptcy. This is Westwood One.